Welcome back, everyone, to our monthly Market Outlook webinar series, where we provide a comprehensive perspective on markets and our investment strategies. We are pleased to have with us Mr. Hitesh Arora. He is a fund manager at Abakkus. He brings nearly 2 decades of rich experience in domestic and global markets. He has also worked with Unifi Capital, Deutsche Bank, and JP Morgan. Also holds an MBA from IIM Bangalore, is an MS in Financial Engineering from Columbia University, New York, and a BTech honors from IIT Kharagpur. He is also a CFA charter holder. So today we will be sharing a detailed market outlook, the macro and micro events, and we request your kind attention during this call and encourage you to have your questions ready for an engaging and insightful session. Over to you, Hitesh, sir.
Thank you, Shwarya. Thanks. Good evening, all. I hope I'm audible. So just in continuation of the format from previous times, what we'll do is we'll start with the market outlook, discuss how our portfolios are, how they are positioned, what's their performance being, holdings, etc., top holdings, and then we'll move on to the Q&A. So we'll just start with what the current market situation is. So just So this slide summarizes the historical performance for the Nifty mid cap and the small cap indices, as well as the major global indices of different countries. So if you could look for the Indian market, specifically in the Indian mid and the small caps, the the recent rally is captured in the 1 month return, and including the post the Feb fall, the returns have been the rebound has been quite sharp, which is reflected in the 3 months return. So if you just look at on 3 months basis, we've done exceedingly well. Look at us on a 6 months basis, returns are broadly are lackluster. And you'd see on a 1 year basis that actually some of the other markets like the likes of Germany or a Hong Kong or a Singapore have done exceedingly well. But I think what's more important is if we go back a little more from a longer term horizon, 3 years, 5 years perspective, I think the Indian markets are top there, but done exceptionally well after COVID, post COVID. After strong performance for about 4 years, markets sort of took a break, and that was, and we will discuss those reasons in more details over the next a couple of slides. So markets took a breather, but seem to be coming back strongly in this financial year. So this is just a brief snapshot of the performance vis-a-vis the other index over short to medium term to 5 years, up to 5 years. So I think what's been on everybody's minds is the Trump's tariffs, and this has been for a while now. Actually, what the markets would have thought would be, or at least President Trump would have actually thought would be, would be resolved rather quickly, has been going on for quite some time. And even when we discussed the presentation, there was a lot of back and forth in terms of what the initial Trump tariffs were and how they were initially increased, brought down. So there's been a lot of ups and downs in terms of the tariffs, a lot of exceptions that we were made. So between US and the different partners, including the bigger trading partners, including the likes of China, European Union, or India. So there's been a lot of talks. There's been a lot of numbers in terms of tariffs. There's been a lot of exceptions every day in terms of as the discussions progress, or as the sort of the immediate strategic needs of the country are. Both sides, whether it's China or whether it's the US. So there's been a lot of back forth in terms of the numbers. But the sum of substance of that is that this causes a lot of uncertainty in the markets. So a lot of that causes a lot of uncertainty. It causes, at least in the near term, fear of recession. It could lead to inflation in the US as well, because US would be importing a lot of these things at a higher prices, and it is not practical to set up capacities in the time frame that probably the government in the US is envisaging. So a lot of uncertainties. There's a lot of postponement of capex spends, a lot of differences in terms of who will absorb the tariffs, whether it's the importing country or the one who's exporting it. For example, whether it's exporting, if India is exporting some garments to the US, who will absorb the differential tariff of, say, 10%, which is currently there. So a lot of things are there, and a lot of imports have been sort of postponed until sort of clarity emerges. So a lot of decision making has been postponed, which leads to, which markets don't like, and which postpones spending also. So that is there. But of what we believe, so this is in the near term, right? This will something be this. A negotiating environment will be there for, it can't be for too long, but I think for next at least 1 or 2 quarters, it will be there, and these discussions are very extremely complex. Uh, uh, Having said that, I think over the medium term, India should be a net beneficiary of the same, given implicit assumption is that the US wants to reduce its dependence on China, move away the supply chains from China. And also, we've also seen in terms of the heavier, the rare earth metals, the conditions and the constraints that the Chinese government have been put on exporting those. So, all these comes to the forefront, some of the concerns that the US has. And we feel that India would be a net beneficiary of that, whether it's chemicals, whether it's pharma, whether it's general manufacturing, whether it's in the the lower end segment, like uh, the garment exports, etc. So India should be, which should be substituted out of China to India, or its extensions of China, such as Vietnam, to India. So India should be a net beneficiary of those things. Uh, in the medium to long term, and hence, as an economy, from this Trump tariff angle, ignoring the short term, I think we are well positioned to not only tackle that, but also to actually benefit from this tariff war that the US government has initiated. So this is something that's on the back of my mind, but let's move to other things. How's the domestic economy doing? How's the rupee been doing? So post the election of Trump, in, I think, back in November, the dollar significantly rallied against all major currencies. So if you've seen this graph here on the left top left side, the dollar actually appreciated quite significantly, which is the light blue line. So the dollar index moved quite sharply, but it did give up some of the gains, as other countries, including Europe, especially, for example, Germany, started to focus on their own manufacturing, including defense and other industries. The dollar index gave up its gains. Similarly, the movement has also been seen with rupees. When the dollar appreciated, as with all other EM currencies, the rupee also depreciated some bit, but again, it gained back some of the losses that it had. So on a overall, over a 12-month period, I think the rupee's done reasonably well. We've depreciated by just around 2%. So by any means, the currency is quite stable in terms of the performance. In fact, it's the dollar that has depreciated quite sharply against the other currencies. And in fact, if we actually compare our performance to the other EM currencies, EM pack, I think the rupee's done a reasonably good job from that perspective. One of the things that we draw comfort is also the fact that our forex reserves are at an all-time high, which is also shown in the chart on the top right side. So yeah, that's about, and we'll delve into why the rupees has done well, etc. All the domestic factors around the economy also we will discuss in the coming slides. And next is this slide. I think this is quite topical from what we hear from on a daily basis, where the flows are, how foreign investors, how domestic investors have been behaving. So one of the things that actually drew attention during the beginning of the year, the first 2 months of this calendar year, Jan and Feb, was a whole lot of FII selling. So which is captured in this, if it's in the graph on the table on the top left in the under the CY25 column. So there's been, and these numbers are in dollar million. So there was a significant selling by the FIIs in the months of Jan and Feb. Uh, Large parts of it was obviously absorbed by the domestic industry and specifically the mutual fund industry, but which was part of it which led to obviously the sharp correction in the market that we discussed previously. But since then FIIs seem to have come back both on the primary side and more so on the secondary side. So, since March, we've been seeing net inflows from the FII side. The numbers on an absolute level are not that big, but the trend is clearly reversing, especially over the months of April and May. And I think this trend should continue and improve from here on. What also is important is the size of buying of the Indian DIIs, which is largely the mutual funds. Compared to, if you look at 2 3 years prior to CY25, the size of the buying is of the order of $23 billion or $20 billion. Last year it was $50 billion. But if you actually just look for 5 months during the course of this year, we've exceeded more than $20 billion. So this itself gives you the size of the domestic investor, what is the size of the domestic investor, and how it's grown sharply over the last 3 4 years. So I think that's extremely important. So this was a point I wanted to make. Just to recap, there was significant selling by the by the FIIs in the months of Jan and Feb. Large parts of it was absorbed by the domestic investors. And the second point is the size of the domestic investors, which is a reflection of the interest in the economy and the sort of the equity culture that we sort of now move to, which is reflected in the size of the buying by the domestic institutional investors. So these are the 2 points that are key here. Just in terms of the GDP trends and which can relate back to the stability of the domestic currency. So the Q4 FY25 number, GDP growth came to 7.4, which is slightly above expectations. Full year was about 6.5%. FY26, the estimates are of the order of 6.5%. I mean, some hit is also on account of the sort of the tariff wars, so that takes away 50 60 basis points. But for that, we could have done better. But otherwise, I think the estimate is that while official estimates are around 6.5, I think we could do better than the 6.5 number. And it's due to a lot of factors that are actually currently in favor of the Indian economy. Uh, you know, the negative is obviously the global uncertainty, the tariff war, geopolitical uncertainty, things like that. But on the domestic front, a couple of things. Inflation is well under control, especially the food inflation, which had moved up sharply, which is well under control. Inflation numbers, recent inflation numbers came at around 3.6, 3.7%, which is well under the RBI's comfort level of 4%. So inflation levels are benign. Most importantly for India, oil prices are benign at sub $70. So that gives a significant cushion to the economy. We are spending in a measured way. While when we are spending a lot, but our spending is in a measured way. So in terms of the fiscal deficit as a percentage, is well under control. Whatever we budgeted, we spending around that, and that glide path is declining, and we'll discuss it in the following slides as well. But I think what is very key is the growth of the economy vis-a-vis the West. Our growth paths compared to the West are diverging. Though on an absolute level, a 6.5 or a 7% may seem lower, but compared to the Western world, the delta is significant, where the Western world is growing at 0.8, 1%, or maybe 1.1, depending on which 1.1 to 1.5 where you're looking at. The divergence in growth of a delta of around 5% is quite significant, which provides, which makes India a very attractive destination compared to some of the other countries in the world. So it's one of the top five economies of the world, which is growing at a significant pace. Makes it an attractive destination for investors, and some of the factors in terms of demand, the benign macro environment, those things are in control, which is a positive sign. So just in terms of, there have been some concerns around, and I'll just take to both these slides in conjunction. There've been a lot of, over the past years, there were a lot of, over the past year, there was a lot of concern around slowdown, and rightly so, because, we'd had a strong growth post-COVID. Things seem to have slowed down given it was election year, so spending had slowed down, and some extraneous factors like uh, weather-related conditions and things like that. So a lot of factors, that had played. So things had sort of slowed down a bit, but and higher inflation as well. So food prices were higher. So a lot of things coming together, which had sort of slowed down growth, which was reflected in the lower earnings growth, and markets had then run out ahead of themselves, and then they corrected quite sharply in H2. But what's a good part of the government and the central bank is that they've been very proactive in taking measures, whether it was cutting risk weights for bank loans to NBFCs and microfinance companies, so which added, which aids credit growth in the economies, especially in some of the sectors which need it the most post the sort of the MFI crisis that we saw. So the very proactive sense in that sense, and also as inflation was under control. The central bank over H1 CY25, so over this calendar year, has cut repo rate by a good 100 basis points, including the last cut by 50 basis points. This is And the second measure which is reflected in the slide, is uh, uh, a CRR cut of 100 basis points, taking the CRR cut to 3%, which will be implemented in a staggered measure from September to November over the course of this year. So, significant injection of liquidity that will be there, that should aid the domestic economy, that should aid credit growth in the economy, that should lower interest rates, should help credit offtake. It should cheaper the EMIs of the of the borrower. So things like that should aid demand in the economy. I think ultimately what is the driver is domestic demand, which has a trickle down effect in the economy. So a lot of measures that have been taken. So one of this is on the banking side that has been taken. So that's on the monetary policies side that the central bank has taken to spur growth. And then there have obviously been measures, in the central budget that was there presented in Feb. So we'll see those benefits also trickling down over the course of the year. But some of the important ones we've discussed it in the past, but just to sort of recap, was the reduction, the revised tax slabs under the new tax regime, so where they reduce the tax rates, which should lead to a total tax savings of about rupees 1 lakh crore, which should see some bit of it in savings, but also a large bit of it in consumption. And consumption as has a trickle down effect, whether it's, if you buy a car, you take a loan to buy a car, which aids credit growth. The automobile company benefits, the employees working there benefits. It deploys more capex, it deploys more people, it increases salaries, its profits increases, it increases salaries. It buys goods from auto ancillary companies, which again buys goods from raw material from metals and metal companies. So all this has a trickle down effect in the economy. So one bit of consumption, say buying a car, has multiple trickle down effects in the to various sectors of the economy. So that should benefit. Not only that, there's been significant thrust on access to cheap credit, significant thrust on higher spending on rural and agri by way of different schemes. And the allocations to something like a PM Awas Yojana, rural or urban, those allocations have also gone up. So all these measures, and we'll discuss in a little more detail the agri economy. There's been a significant pickup seen in the rural economy, which was lagging for a good 3-4 years. So that will also have a significant impact. So I'll just take 1 or 2 minutes to just on the graphs on the top. They are a bit they're a bit difficult to read, but they're quite important in that sense, in terms of the what the government has been trying to do, and how it's trying to derive growth, at least some parts of it. So as one of the things that we said was fiscal deficit as a percentage of GDP, which had significantly shot up post COVID, and because the government spending that it did to lift the economy, to which went up to as high as 9.2 levels, is coming back sharply, and as based on the glide path that's been given by the government. So I think we closed the year with 4.8% fiscal deficit as a percentage of the GDP, and the FY26 guidance is will come down to 4.4% of the GDP. So we are spending within our means. So that is the important bit. We are spending within our means. While we are spending, budget capex budgets have gone up by 10%, etc. Important is which keeps the interest rate stable, the currency stable. So these macro factors are a huge positive. So interest rates our import bills are under control, our interest rate costs are under control, things like that. But what is also important is the last year, which is the graph in the middle, shows that the capex growth in an election year had significantly come off. So these are the capex growth numbers on a YOY basis over the last 12 months for each month that we've shown. So as you can see, capex growth compared to the previous year, same month, was negative for most part of the year, because it was various factors, state elections, central government elections. So a lot of so you couldn't spend, and the mood was something else, and some domestic also factors like uh, extended weather related some issues. But some of these things have come back quite strongly. So since you see, even since March, post when since the new budget was presented in Feb, since March, the capex spending has gone up quite significantly. It's a virtual U curve there. Uh, so March, significant increase in spending on a YOY basis, and April was a strong 61% on the back of a very low base. So capex spending, the government couldn't meet its target in FY25. It revised its targets down, and for the budgeted estimate for FY25, and now on those and on since then, we've been on an uptrend. So I think this is significantly important, that we are there's a significant spending by the government, which is quite essential for the economy. I think the other bit is this graph on the right, which talks about central government capex as a percentage of the GDP. What it shows in a sense is that the central government spending was less than 2%, so 1.7% in the period from FY 17 to 20, which has significantly gone up to over 3%, in the last few years. So the central government spending has significantly gone up. So both on an absolute level as well as the both factors. So the GDP is also increasing, and so hence we are spending more, and as a proportion of the GDP also we are spending more. So not only is the denominator increasing, but also on that increased denominator we are also spending a higher amount of money. So there's a significant increase, almost double in terms of percentage terms, but on absolute terms, I think because the GDP itself is also growing, nominal GDP is growing by 11-12%. On those factors, also as a percentage, we've significantly more. So I think this is very important, to a very important factor driving growth. And just on inflation and interest rate dynamics, as we said, inflation is well under control compared to the latest inflation print came at 3.16%, well within RBI's comfort level of 4%. So this is that. A large part of last year was driven by food inflation, and thankfully, given the early onset of monsoon, I think food inflation should remain under control. And so this trend of easing inflation at around 3.2 to 3.5% should stay. What is also reflected is in the 10-year yields. So while you'll see different countries behaving differently, German yields have gone up sharply. US inflation went up sharply in the West. Inflation went up sharply in the West, but it was brought under control. But the Indian yields, Indian rates have been trending lower, but at a very steady pace. Generally, it's a very steady pace. Indian 10-year yields, nominal rates have been very steady with a sort of a downward bias. So I think which bodes well, which shows the health of the economy. I think, and what has sort of helped us is also, as I said, it's the direction of the crude prices, which is shown in the table on the bottom right. So broadly a unidirectional downward trend, which has helped capture, helped us manage inflation better, if I may say. And also, which is again how repo rates, we've discussed it. We've looked at 100 basis points cut over the last 6 months or so. So that's reflected in the repo rate. We're looking at a repo rate of currently of 5.5, which, as I said, should lower costs for households, should spur household credit demand, etc. So I think that's a significant positive here. Just looking at the markets and valuations, because that's sort of the key for us. I think there's a lot of talk around where markets are, where valuations are. I think markets are not cheap. I think, in a sense, what is the key is here is markets are not cheap. Nifty P1 forward trades at around 18 times. That was the number. It may have gone up slightly more given the rally in the last 3-4 days. So this number is as of end of May. But broadly, we are thereabouts, right? India was never a cheap market, given various factors, right? I mean, we discussed it's the largest, fastest growing economy in the world. So, obviously, and a lot of flows there. So it's not cheap, but it's also at the, our return ratios are good. Nifty ROEs are at a good 15% numbers. It trades close to the ROEs are compared to where their average are. So compared to the long-term average, so it's there. So ROEs are at the closer to the long-term average. Ps are closer to the long-term average. But on an absolute basis, it's not cheap, but probably more or less fairly valued. But again, something this is to keep in mind. This is for Nifty. This is not for the whole index. There are stocks beyond Nifty 50 also, right? And this is an average. So average is an average. So we just have to take it with a pinch of salt. Specifically, I think what is important is also to dive down a bit more to look at sectoral valuations. One of the sectors, we've shown the P for different sectors. So as you know that some of the sectors that are sort of hot or more expensive than the others, given the probably the growth, the focus of the government in terms of spending and make in India and infrastructure spending, defense spending, those kind of things, or Atmanirbhar Bharat, those kind of things, railways. So capital goods is an industry where the PEs are generally higher, given the thrust of the economy there. IT is expensive. So post-COVID, IT valuations have run up. The earnings are not so great, but the stocks haven't corrected in that as much as they should have. So the PEs for the different reasons for the capital goods as the IT sector are higher than average. Banks are cheaper compared to their longer average. So that's that. And so are but that's on the private bank side. PSU banks have done well. At least they've sort of changed. The books have sort of the banking books have improved. The balance sheet has improved. I'm sorry. The balance sheet has improved. Credit growth looks good. So the PSU banks that were cheaper for a very long time, at the last 3-4 years, have come up. Pharma is a different story. It's driven, a lot of it is driven by CDMO, China plus one, strong domestic demand. So while valuations have corrected, they're still higher compared to their mean. There may be merit to the story, but at least on the face of it, the pharma valuations are expensive. Auto trades closer to the mean. Yeah. Well, within that also there's you can classify between two-wheelers and PVs and CVs, but this is on an average level. So the other one is consumer, and consumer is, it generally trades expensive, and that's where it has, despite earnings not being around, but that's this in terms of whether it's consumer and consumer discretionary, all the more expensive there. Yeah. And the table on the right is what are the returns for the different sectors. So you can just have a quick glance in terms of different subsectors of Nifty, whether it's Nifty IT, Nifty Bank. What are the returns of the 5-10 year period? So this is just for reference. Just to give you a quick one. Nifty PSU Bank Index has done exceedingly well post COVID. So that's a strong CAGR. You're looking at around 45%. Nifty Reality is again of a low base, did exceedingly well. Yeah, so those are our Nifty Metals Index also post COVID of a very low base. The Nifty Metals Index over a 5-year period has done exceedingly well post cleaning up of balance sheets, etc. Lower leveraged. So those are the strong indices over the last 5-year period. 10-year periods may obviously were pre-COVID, so they'll tell you a different story. But this is just for your reference. But just to continue with that, there are a lot of positives, which is reflected in terms of the robust GST collections, which is the graph is largely upward sloping, or the infrastructure spend, which is reflected in, for example, as a proxy in the highway construction, or our monthly energy consumption, or the UPI transactions. So we are becoming a more and more digital economy. So things like that. So, just good macro indicators for a reference tech, which should be reflected in the state of the economy. So this is, again, a reflection of what we've discussed. Credit growth remains largely strong compared to what it has been on the average. And we think that with the recent rate cut, the industry credit growth for this year should obviously be higher than what it has been the previous year, which had slowed down post strong growth over the last 3 years. And the other one was the center's capex. So this is an important number. It's the YoY growth in the capital expenditure by the center. Numbers have significantly post-COVID. There was a significant increase in spending by the government, which is reflected in the sharp uptrend in the graph. It moved, which shows last year was a significant decline given the election year, etc. So, that number was just a YoY growth of 7.3%. In FY26, as per the budgeted estimate, we are looking at a growth of 10.1%. So that's what we are looking at. I think the government could do well there. I think if the economy picks up, I think post the lull in last year, I think we might exceed this number in terms of the capital expenditure. Yeah. So, and just in terms of how results have been for Nifty, so it doesn't reflect the full universe, but for whatever it's worth, it reflects the top 50 companies, and it gives a sort of a top-down view of the economy. So just to recap, Q3 numbers, Q3, FI25 numbers were really poor in terms of the earnings expectations, etc. So, which also reflected in the steep correction in the months of Jan and Feb, right? So, markets reflect earnings growth. So, earnings growth was really weak after, and the markets had gone ahead of themselves, and then they got the check in terms of the markets got a reality check in terms of the earnings growth. So earnings growth was really weak and the markets corrected. Of that lower expectations, markets done slightly better. So once the earnings estimates were adjusted, so for example, Nifty PAT earnings estimate for Q4 was around 2%. The PAT came to 3%. So based on the lower expectations, I think we did reasonably okay. Overall, I think for FY25, we did a PAT growth of around, corporate India saw a PAT growth of around 10 to 10.1%, which was actually broadly in line with if you look at it in where the GDP grew, nominal GDP. So real GDP growth of around 6.5% plus, the inflationary adjustment factor of around 3.5 to 4%. So broadly, it was largely in line with the GDP growth or slightly lower. So this is just to, and just this one is an important bit on the graph on the bottom right. What was the contribution of earnings growth by different sectors? So bank, PSUs, and metals and telecom were the major contributors to the growth. What took away some of the growth was a bit of consumer was flat, so it hasn't done anything for a long time. Cement and oil and gas were the bit of the laggards, but the bulk of the contribution in earnings came from banks, metals, and telecom. So what is I think this is what we're looking for. What is the current outlook? I think we've discussed it also. I think we are in a good state. We're currently in a good state compared to the rest of the world. Our domestic economy, domestic demand factors are good. Last year was slow off a strong base of the last couple of years, but given the base correction and given the strong sort of proactive measures, both by the government in its budget in terms of the capital expenditure and the policy measures that it has taken and the budgetary allocations to sort of rural spending, I think we are in a good state in terms of demand. There's a lot of focus, if you look at, is on Make in India, Atmanirbhar Bharat, import substitution. Those are real discussions that are happening. Defense is a good sort of demand driver for of a strong part of the overall defense as a part of the total order book of companies, if I may say, is a very strong component. So a lot of focus on indigenization, self-reliance, import substitution is there across the economy. And then we've got the advantage from this whole China plus one that we should see flowing towards us for the next couple of years, whether it's garments, whether it's chemicals, whether it's pharma, things like that. So it is for us to take it. It is for the Indian corporate sector to take it. And yeah, so the other bit is rural demand was slow for a long time, but back on some of the measures like government spending on rural spend centric schemes that I mentioned, a strong Rabi season, higher yield, stable pricing for Rabi, early arrival for monsoon. So we're looking at slightly above normal monsoon this year. So things like that should aid rural demand, and which should, rural recovery, rural incomes, which should in turn lead to higher consumer spending. So the consumer spending has been lackluster for a while, especially rural spending. Wage growth has been stagnant, but hopefully with some of these green shoots, I think we should see growth coming back in terms of the consumer spending. Yeah, so some of these factors we've already discussed, and I think, yeah, so there's nothing specifically new here that we've not discussed over the last 30-40 minutes. I'll quickly, so this is the risks that we are there: global slowdown, tariff trade wars, we've discussed geopolitical tensions, again, Russia-Ukraine war, and we had this small incident with Pakistan as well. Those things. So those are the risks to the economies. Importantly, this tariff war, if it continues, and that decision making is postponed, so that could be a hangover that could shave off 50-60 bips of our GDP. So that's important to note. So I'll just quickly move in the interest of time. I think I've run up a bit. I'll just, in terms of philosophy, we've discussed, I think in the past, so I assume you're well aware of our philosophy, but I'll just quick 1 minute. We are very bottom-up focused, fundamental investors, very valuation conscious. We are, each investment's on its own merits. We are not allocators. We do our own bottom-up research. We've got a strong research team that aids us. We've got strong, our CI has got a strong experience there, and strong in industry connects in terms of the networks that we've built, the understanding of the industries that we have, the market industry of the market cycles, that sort of reflects in the understanding, that reflect of the years of experience that this team has. So, in that sense, I think we are good, but we could discuss this more in terms of the Q&A and asset during Q&A. But just quickly, I'll just take you to the portfolio bit, because that's also quite important. So we run 3 strategies. So the first one is the all cap approach. So, the previous year, FY25 was a bit slow for us, given post, again, strong returns over last 3-4 years, and then sort of a period of consolidation. But we seem to be doing reasonably well over the last 3 months, since the correction, since the market correction post Feb, and especially last month has been pretty good for us. So last month, I mean, is May, and June also. Last 10 days of June also continue to be well for us. So we're doing reasonably well. And just in terms of the all cap approach, just to remind ourselves, it's largely a large cap portfolio. So around 50% of the portfolio is large cap, followed by almost by 27% allocation, or a quarter percent of the portfolio towards the mid cap. So roughly around 75% of the portfolio is large caps and large mid caps, followed by around 18% weight to the small caps. And these are some of the top holdings and holdings by sector. I'll just pause for a quick 5 seconds for you to have a look. I think important is while we've got three different strategies, our fundamental philosophy of being sector agnostic, being very bottom up focused remains the same across all these three strategies. And this is just the valuation matrix and the ROEs and the profit growth expectations for our portfolio company. So I think so this is something key. This is a key matrix to look at, and that's something that we monitor very closely. So the next one is the emerging opportunities approach, which is where emerging is largely a mid and a small cap sort of a portfolio. So around, if I can say, around 85-90% of the portfolio is split between mid and small, with a small allocation of around 6-7% to large cap stocks. So it's largely a mid and a small cap portfolio. Again, it's a portfolio that's done reasonably well last year and over the longer term as well. And continues to do well in this financial year as well. So the portfolio continues to do well, and this is just a quick snapshot of what are the names that are there. And yeah, I think, this is just the valuations. The other one is the diversified alpha approach. So what is diversified alpha? It is split across, all large caps, mid cap and small cap names, in the broadly in the 40-30-20% ratio. And the last year performance, as I said, was slightly below par again, but this year continues to be, the portfolio continues to do okay. There is a higher amount of cash in this portfolio. We continue to evaluate opportunities, here. We are one of the sort of concerns and let me address it right here as well. One of the concerns of investors is that we hold a larger amount of cash over here. So we are evaluating opportunities. We are constantly opportunity. We've invested a few as well over here. If you look at the past few months, we've invested a few. We continue to evaluate, and hopefully, we don't. So we are not allocators in that sense. So we are very bottom-up investors. So you don't want to be carried away by momentum, carried away by time running by, and let's invest for the sake of investing. No, we want to stay true to our core, true to our philosophy, and hence, in some instances, taking slightly more time to invest in opportunities. So I think so. This is just in terms of the valuations, etc., for this portfolio. I'll just stop here for a moment and let's start with the Q&A.
Okay. So thank you, sir, for this insightful session. We hope it has provided valuable updates. Let's proceed with the Q&A. Just a small reminder, as a part of our best practice, we kindly request you all to avoid stock-specific questions. Would appreciate your understanding. So let's start with the questions. So sir, the question is, with US 10-year at 4.5%, 30-year at the rate 5%, and currency risk of 3 to 4%, what's your sense of a current equity risk premium that FPIs would demand? In that light, how's the expected earnings projection for index or broader market?
See, what is the risk premium for investors? I think it's not. I have a better handle, so I'll discuss what is the expected earnings, and I think that is more important. FI's return expectation is also will be under the should also cover broadly. Our GDP estimate is around 6.5%, with we probably can overshoot by 20-30 bips in my estimate. We are looking at the deflator so the nominal GDP should come around 10.5 to 11%, not more. Okay, so last year it was FY25 was, I think, around the 10% bracket. This year it may be 10.5 to 11. Okay. and last year profit growth was 10. This year, I think of a low base, we should do better. So more normally, broadly, we are looking at 12.5%, 12.5% earnings growth. Over the long term, earnings, stock prices should reflect earnings growth. So stock returns or market returns should reflect earnings growth. So at a market level, this is the earnings growth that we are looking at a market level. Obviously, there'll be volatility between industries or discrepancies, because here we're talking about average. We're talking about averages, and we're talking about generic averages between sectors, between names within the same sector, between industries. There'll always be there'll always be differences, but at a market level, this is what we are talking about.
Okay. The second question is, what is your view for the petroleum sector?
The petroleum is normally what happens is oil higher oil prices lead to more incentives, if I may say, for exploration, right? Where your returns will be higher, so you do more digging, you do more sort of geological research, you look for oil fields, etc. So at the moment, I think given the lower oil prices, things may look a little on the. My personal view is they may look a little on the softer side. But if oil prices go up, then things could change quite dramatically. So it's closely a function of I think, of the oil prices.
Okay. The next question is correction in mid and small cap over?
I think the period of sharp correction that we saw in H2, I think that period, in my personal opinion, I could be wrong also, but in my opinion, the period of sharp correction is behind us. Some of the earnings trajectory will improve from here on. Markets are not cheap. We know that, and that's always been the case with India. But just in terms of better earnings outlook compared to last year, a lot of chemical sector names starting to do well. Some of the the hopefully the pharma and the capital goods space also doing well, and rural consumption also picking up. I think I don't think so. A steep correction is warranted.
Uh, the next is your views on the outlook and views on the portfolios, all three schemes.
See, broadly, as I said, we at an index level, it mirrors the GDP growth. So, we're looking at an index level, we're probably looking at 12.5% to say 13% PAT growth. But our portfolios, and as an active portfolio manager, our portfolios are positioned better. We That's what we try and do. We pick and choose portfolios and names that can deliver better earnings growth. We are slightly skewed towards slightly skewed more towards financials. And some of it will be a balance between sort of large private banks or large PSU banks, as well as sort of NBFC, which some NBFCs which are lower down the risk curve. So in this period, I think we are positioned quite well. Our portfolios are positioned quite well across to deliver better than index earnings, to definitely deliver better than index earnings, and returns should mirror that. So once your earnings come, returns should follow that, and our portfolios are positioned better, whether it's in terms of cyclicals or financials, which are cheaper and which should, given various consumer sentiment policy measures, RBI, for example, giving more leeway to risk taking, whether it's a higher LTV for gold loans, for example, or risk weights to MFI or NBFC, those kind of things. I think our portfolios are positioned well to deliver much better than uh, you know index earnings growth. So I'll put it that way.
Okay. The next question is, if someone was putting in fresh money in today's current scenario, which scheme would you recommend?
See, all the schemes are babies, so we manage them with equal passion. So in terms, there's no for us, it's no difference. Uh, Honestly, it would be for me. It's equally, it would be uh, equally same. It just depends on it. The answer lies with you. What is your risk taking ability? If you are looking for higher risk, then probably emerging. If you're looking for lower risk, then it's probably the all cap strategy, because it's largely more large cap, which are generally more stable. Uh, Versus an emerging, which is more mid and the small cap. So I think the answer lies within what's your risk appetite or return expectations. So when you're taking slightly higher risk, returns you can expect to make slightly better returns. So that's where the answer is.
Okay. The next question is, given the US uncertainty, your views on IT sector.
Yeah, so it is no, it's a bit of a concern there, but the good part is IT is the core for any big US companies, for all the Fortune 500 companies. So the IT backbone is the core. I think there is definitely near term uncertainty there, no doubts about it, no denying it. But hopefully, when this tariff uncertainty sort of goes away, I think spending should come back in a big way. So the guidance the companies have given is very benign. I think they should overshoot what their guidance is. They're also being conservative. But once this, I think the IT sector hasn't done great for some time. So, the base is also favorable. Once this uncertainty goes away, I think the sector should come back well.
Okay. The next question is with respect to rate cut. Who will be the best beneficiary of interest rate reduction, banks or NBFC?
I think if I can say, it's NBFCs. NBFCs are better. Their bulk of their books are fixed rate. Their borrowings, they're very heavy dependent on borrowings, which are again fixed rate. Risk sentiment is improved, so people come and uh, just borrow more. LTV limits, for example, for the gold financiers, MFIs, and all that. We are past the worst. I think in this cycle, I think NBFC will be a bigger beneficiary.
Okay. The next question is, what is your view on telecom space?
So see, telecom is a big space, but I think we like the space. We generally like the space. It's quasi consumer, or it's almost consumer. It's very essential to our day-to-day business. And I think what's happened is also peak capex intensity is behind us. So these companies, at least the big majors, are doing significant FCF generation. Free cash flow generation is significantly higher. We've demonstrated that we can take price hikes, and I think we are amongst the cheapest in terms of the ARPU, what is the average revenue per user. So there is significant scope over there. Uh, so the outlook and obviously demand will continue to grow. So there is no sort of terminal value risk. We continue to grow. Uh, and the growth, both in terms of the users, probably not, as well as more importantly on the average revenue per user or the tariff rates, if I may say, should continue. And importantly, the peak capex intensity is behind us. So I think we'll be good in that sense.
Okay. What is your view on commodities like zinc, gold, silver when oil is down?
It's a very, it's not our sort of core. We look at equities, but from a investors, just from a bit higher level, gold has done the strong demand for gold, from the central banks, etc., as a safe haven, etc. Given geopolitical tensions, I think gold's done very strong. Uh, so that but whether the incremental returns will come is something of a question. Post a very strong rally, there'll be some consolidation there. Something like a silver, I think silver is catching up. Silver hadn't run up as much in the past when the gold was rallying, and silver also has an industrial use as well. So there is a lot of merit to there's a lot of demand there, and silver is always in a short. Demand is higher than production, so the silver has industrial use. So that demand should aid prices, and that we've been seeing in the last, I think, last month or so, silver prices have rallied. So yeah.
Okay. So the next question is sectors rotate very fast these days in the Indian market. Are you sure your approach to slow bottom up investing will help to beat the competitors? Don't you need to consider the momentum strategies as well?
See, we are looking at overall returns perspective. We're not here to beat competition. We're so that's not the goal. We are uh, the idea is to generate returns for the investor and not beat competition. That's the goal we are looking at. And it's important that we stick true to a philosophy where we have comfort, which is time proven for us, which is tested, which is our underlying philosophy. Chasing returns, mimicking others, what others are doing, or what doesn't fundamentally doesn't make sense to us will not hold us in good stead in the long run. Yes, over a short period of time we may do it, but remember, something that goes up very fast also corrects very fast. So until unless you have a very good understanding of a name, we would be very hesitant to jump. We wouldn't know how to react when some of these things correct, because we didn't know why we invested into it at the first place. So it's very important to stay true to the core, to our philosophy, and that's, I think, over a long period of time that has done for us, and we continue to believe in that. We'll not compare ourselves with the competition's returns.
Okay. The next question is, given the current market environment, are there any sectors which you wish to avoid?
No, we are sector agnostic. It's just where demand is a little slow. It hasn't, demand is slow, but something like a staples where demand is low, uh, but prices are, valuations are high, which we anyways are avoiding. You won't find one of much of these names in your portfolios. So those we continue to avoid, and you won't see those in our portfolios as well. So. But
Okay.
otherwise, we are sector agnostic. So there's nothing.
Okay. Three more sector views, that is textile, paint, and aviation.
See, some of these are good, but whether it's aviation is good, but not point in discussing it because I don't think so. We have it in our portfolios. So while aviation is good and which is reflected, and they're not, but unfortunately, there are many names that we can play with. There are not many listed companies that we can play with. So probably, in hindsight, it was a good idea, but we don't have many. And so one was cement and the other one was
Paint and
and paint
aviation.
and paint,
Textile.
aviation, and third one was
Textiles. Textile.
textile. Yeah, textile is good. This given this whole US opportunity, and this US China plus one opportunity. But you have to keep in mind that it's a very labor intensive industry, so it takes a lot of time to set up capacity. So some of it is labor intensive. You have to train people, and then people leave by when they are trained. So labor is, it's a bit of a challenge. Over a long term, it may do well, but I think stocks have run ahead of themselves in terms of the numbers have not come. Paints, it's I think it's a bit of a mixed picture here. The leader continues to lose market share because it's just the nature of the industry. Its competitive intensity has gone up, and more players and bigger brand name players with deeper pockets are coming up. So the market share, it was more of a sort of a duopoly, that kind of a market structure. But the bigger players are now losing market share. Pricing power is going away as there are, as competition sort of comes in. So yeah, it's a bit tricky at the moment.
Okay, so I think we are done with the questions, sir, majorly. Any concluding remarks from your side?
No, so I think one is just want to assure investors we are deploying, we are especially on the diversified alpha, we are evaluating opportunities where we think names have run ahead of themselves. We are also optimizing portfolios there. You may have seen some changes in your portfolios. Uh, this is one bit, and the other is, as I said, I think we are on a good stead domestically. We are in the right place. We have a lot of tailwinds with us, so it's just so the time is good in that sense, and it's just we just need to continue to do our jobs well. That's all. So the onus is on us to continue to do the job well. That's it, really.
Okay, thank you. So, with this, we can conclude today's call. Thank you all for joining us on this Tuesday evening. We look forward to connecting with you all again next month. Thank you.
All investments are subject to market risks. Please read all scheme-related documents carefully before investing. Performance and references to returns are indicative and does not guarantee any returns. Investor discretion is advised. This video is neither a general offer nor solicitation to avail the service of investment from the CB registered intermediary under the services offered by Abakkus, nor is it an offer to sell or a generally solicit an offer to become an investor in the services offered by the Abakkus. The delivery of this video at any time does not imply that information herein is correct as of any time subsequent to its date. The contents of this video are provisional and may be subject to change.